Ukraine is a nation at war after Russia launched a full-scale invasion of the former Soviet state.
As heavy fighting continues on the Eastern Front, Russian forces are raining artillery fire on the southern Kherson region.
Russia's invasion of Ukraine on February 24, 2022 not only led to a devastating loss of life, it set the global economy on a path no one saw coming.
That has been clearly very damaging in terms of the supply of raw materials, of fuel, in particular oil, and that's just generated substantial inflation and cost of living pressures around the world.
Higher energy bills impacted Australian households and businesses and led to soaring consumer prices.
This is the biggest challenge to central bank inflation targets since the advent of those inflation targets back in the early 1990s.
Inflation reached double digits in the US and UK. We're yet to see the peak in Australia. It's likely to hit about 8% by the end of 2022. Globally, central banks took decisive action.
Most central banks have really been caught out by the pace of the increase of inflation and ended up raising interest rates a lot more than they expected at the start of this year.
The RBA lifted the official cash rate at its fastest pace ever, from near zero in April to 3.1% in December.
The bank will need to do at least another couple of rate rises, so perhaps one in February, one in March.
National property prices began falling in May, with values down 7% to the start of December. While much of 2022 was about numbers that didn't necessarily go in the right direction, they weren't all bad.
You think about what's happened this year, whether it's the invasion of Ukraine, whether it's aggressive interest rate increases from central banks all around the world, GDP growth this year is actually quite remarkable.
The high point for Australia was clearly the reopening of the economy post the COVID restrictions. Once the restrictions were removed, there was a significant upside surprise to consumer spending.
The economy grew by almost 6% in the 12 months to September, while the unemployment rate has hovered near a historic low of 3.5% since the middle of the year.
I think that that's a real testament to the flexibility of the economy and the fact that we were able to bring people into the workforce, more people working, hopefully in jobs that they're enjoying and obviously earning a wage.
As the global economy enters a downturn in 2023, there are a few key themes our experts will be looking for.
If we keep going and spending, it's going to be a lot harder for the central bank to take those demand side pressures out of inflation. And history shows us once you get that embedded, that becomes really challenging, much more difficult for policy to respond to.
I think we're going to see the combination of a tight labour market and government decisions, particularly around the minimum wage being pushed up next year, means that overall wage growth accelerates further towards where the RBA has been expecting, which is closer to 4% than 3%.
I'll be looking out for the impact of the size of the return of migration and the impact that that has on the domestic economy.
I do think it would be possible to get a big enough lift in the unemployment rate such that things felt a bit more recession-like.
A recession these economists and Australians hope to avoid.